Welcome to the deep dive. We've got the transcripts, the analysis. Now let's get right into it. Today, we're doing our deep dive into Hanmi Financial Corporation, that's ticker HAFC, and their Q3 2025 earnings call. Management didn't mince words. They called the quarter outstanding. So our job here is to figure out, is this real sustainable strength or maybe just a flash in the pan? We want to find those key drivers that really matter for you, the investor looking beyond the headlines.
Yeah, and the market reaction was pretty immediate, wasn't it? Shares firmed up right after hours, closed higher the next day. Look, when a regional bank throws around outstanding, you got to look under the hood. It makes us really question, okay, how sustainable is this strength? Particularly that net interest margin, the INIM, and critically their credit quality. That's where the real story usually is.
Okay, so let's start with those headline numbers then. They must have been pretty good to warrant that kind of reaction.
Oh, absolutely. The excitement, it makes sense when you see the numbers. HAFC delivered a really strong financial beat. GAAP EPS came in at 73 cents. That comfortably cleared the consensus range, which was sitting around, 65 to 66 cents?
Right.
And revenue also beat expectations. It totaled $70.96 million against a consensus estimate of about $67.8 million.
Okay, strong beats on both top and bottom lines. And the year-over-year growth.
That was substantial, too. That $1.73 EPS is up 49% compared to Q3 of 24, which was $9.49.
Wow, okay. Nearly 50% growth year on year.
Exactly. And sequentially, quarter over quarter, net income jumped, get this, 45.9% to $22.1 million.
Okay, nearly 46% sequential growth in net income. That's huge.
Yeah.
So was there one single thing driving that, or?
It really seems to be a combination, but heavily weighted towards improved efficiency and really solid margin management. In fact, maybe the best way to look at it is their PPNR, that's pre-provision net revenue. Think of it as the bank's core operating earnings power, before they set aside money for potential loan losses.
Right, the clean earnings number.
Exactly. And that PPNR was up a massive 16.4% just from Q2. That shows the engine was really humming.
Okay, 16.4% PPNR growth. Let's unpack that operational power then, starting with the net interest margin, the NIM.
Yeah.
That's always crucial for a bank.
Absolutely vital. And it expanded significantly, 15 basis points quarter over quarter, hitting 3.22%.
15 basis points. In this kind of competitive environment, that's a really significant win, isn't it?
It really is. And the interesting part is how they did it. It wasn't just about getting higher rates on new loans, though that helped a bit. The real story, the true victory here, was on the liability side. Discipline management. They actually managed to lower the average rate they paid on their interest-bearing deposits.
Okay.
Down by 8 basis points compared to Q2. Now, combine that with average loan yields ticking up 10 basis points.
And there's your 15 basis point NIM expansion. Makes sense. Controlling funding costs is key.
Precisely. And that 8 basis point drop sequentially is good, but what really caught my eye in the notes was the acceleration they talked about.
Ah, right. They mentioned October data, didn't they?
Yeah, they did. They highlighted that the month-to-date average rate paid on savings and money market accounts just in the first part of October was already down 23 basis points from the Q3 average.
23 basis points lower already in October. Wow.
Yeah, that's a serious tailwind. It means that margin expansion we saw in Q3, it isn't just history. It's got momentum carrying right into Q4. That could really help offset any, future pressures on loan pricing.
Okay, that's a very strong point on the margin front. Now, moving to efficiency. You mentioned the PPNR growth suggests operating leverage. What about the efficiency ratio itself?
Spot on. That PPNR growth was definitely helped by good expense control. The efficiency ratio improved quite a bit, down to 52.65%.
52.65%. That's pretty good for a regional bank, isn't it? 2-year low, they said.
That's right, 2-year low. And yeah, generally anything under 55% is considered quite efficient. It basically means they're squeezing more revenue out of every dollar they spend on operations. Strong operating leverage.
So controlling costs, expanding margin. But you need growth, too.
Yeah.
Did the loan book expand?
It did. Total loans receivable grew 3.5% quarter over quarter, ending up at $6.53 billion. Solid growth.
Okay, 3.5% is solid. But I kind of saw something about loan production really surging.
Oh, it absolutely surged. That's maybe the other side of the outstanding coin. Loan production jumped an incredible 73% sequentially.
73%, quarter over quarter.
Yep. $571 million in new loans originated in Q3. And it was pretty broad-based, too. C&I lending led the way at about $211 million, but CRE also contributed significantly, around $177 million.
Okay, a 73% jump in production is, well, it's aggressive. Given how competitive things are, especially in CRE, does that raise any flags? Are they maybe chasing growth a bit too hard?
That's always the question you have to ask with that kind of surge, right? Management seems confident, though. Their confidence is reflected in the fact that they actually revised their full year 2025 loan growth guidance upwards.
They did from what to what?
They moved it up to mid-single-digit growth for the full year. Previously, they were guiding to low to mid-single digits. So they're clearly betting that this strong pipeline they're seeing is high quality and sustainable.
Raising guidance after that kind of production surge definitely signals confidence.
Okay, but with rapid growth comes the focus on credit quality. How did that look?
Right, that's the critical counterbalance. And here, the story gets even more positive, maybe even surprising. They described asset quality as excellent.
Excellent is strong language. Do the numbers back that up?
They really do, and in quite a dramatic way. The standout number, honestly, was that the bank reported net recoveries of $500,000 in Q3.
Net recoveries. So they actually recovered more from previously written off loans than they charged off in new losses.
Exactly. That's a huge swing from the prior quarter where they had net charge-offs.
How did they manage that kind of turnaround? Was it broad-based improvement or one big item? A significant chunk of it came from one large item, actually. They had a $2 million recovery on a single loan that had been previously charged off. That obviously makes a big difference.
Oh, okay. A $2 million specific recovery helps explain the swing to net recoveries.
It certainly does. But even beyond that specific win, the underlying trends were good. Non-performing assets, NPAs, decreased almost 18% sequentially.
Wow, nearly 18% down. Where does that put the NPA ratio?
Very clean, just 0.27% of loans. And their allowance for credit losses, the ACL, remains pretty solid at 1.07% of loans. So the credit discipline seems to be holding up despite the growth acceleration.
Okay, 73% production increase, upward guidance revision, and a swing to net recoveries supported by falling NPAs. I can see why management used the word outstanding. That really bucks the trend for some regionals, especially on the credit side.
It definitely does. It suggests very strong execution. But let's move beyond just the core banking metrics for a second. What makes Hanmi maybe a bit different?
Right, their strategic angle.
Exactly. And here's where it gets, I think, really interesting. It's this U.S.-Korean companies initiative, the USKC focus.
Yeah, I saw that mentioned prominently. This cross-border strategy. That definitely sets them apart from your typical U.S. regional bank, doesn't it?
Absolutely. It's a dedicated niche. And according to the call transcript, it's really gaining traction. Apparently, the CEO's recent trip to Korea helped accelerate things.
So is it translating into actual business volume? What do the numbers show?
They do. The growth figures really suggest this is a working proprietary engine for them. USKC loan balances grew 8.2% just in Q3.
8.2%. That's more than double the overall loan growth rate.
Right. And those USKC loans now make up 14% of their total portfolio. But maybe even more importantly is the deposit side.
Are they bringing in deposits from these clients too?
Yes, and significantly. USTC customer deposits crossed the $1 billion mark for the first time ever in Q3. That's now 15% of their total deposits.
Okay, that's huge. It proves it's not just lending, right? They're building full relationships, bringing in core funding from this niche. That's got to be stickier, maybe lower cost funding.
That's exactly the point. It suggests deeper, stickier relationships compared to, say, just chasing hot money with high-rate CDs in the general market.
Speaking of diversifying, beyond the core spread income, what about fee income? Did they mention anything there?
They did. And it seems like another deliberate strategic move. They resumed selling residential mortgages and scaled it up.
Okay, selling them off rather than holding them.
Yeah, selling them into the secondary market. They sold about $68 million worth in Q3 and booked a gain of $1.2 million on those sales.
And is this a one-off, or are they planning to do this regularly?
Management was pretty clear. They anticipate recognizing gains from residential mortgage sales pretty much each quarter going forward, although the amount will obviously depend on market conditions.
Okay, so building a recurring fee income stream there. Anything else on fees?
Yes. They also sold some SBA loans, sold about $32.6 million in SBA 70 loans, and recognized a $1.9 million gain on those sales.
So adding mortgage banking gains and SBA gains creates a nice buffer, diversifies the revenue streams away from just relying on the net interest margin.
Exactly. Makes the earnings profile a bit smoother, a bit less volatile, potentially.
All right. Margin expansion, efficiency gains, strong loan growth, surprisingly good credit, a unique strategic niche, and growing fee income. What about capital and returning cash to shareholders?
Yeah, crucial piece. The bank remains very well capitalized. Their CET1 ratio, Common Equity Tier 1, was strong at 12.0%.
Plenty of buffer there.
Yeah.
Did they put any of that capital to work through buybacks?
They did. They repurchased nearly 200,000 shares of their common stock during Q3. The average price was around $23.45 per share.
Okay. Deploying capital to buy back stock.
Yeah.
And did they give any indication about future buybacks? Is this ongoing?
Yes, and this is pretty important for investors. They explicitly signal that they anticipate ongoing quarterly share repurchases.
How's it going?
Now, they did caution that the magnitude might vary from quarter to quarter, which is standard. But the commitment to continue buying back shares suggests, management thinks the stock is attractively priced and they're committed to returning capital.
Right. That's a strong signal. Okay, so we've painted a very positive picture based on the Q3 results and commentary. Let's connect this back to the bigger picture, maybe acknowledge some potential headwinds or risks.
Absolutely. We have to balance the view. While the execution, particularly on PPNR growth and margin, was genuinely fantastic, the competitive environment hasn't suddenly disappeared. Management themselves noted there's still persistent competitive pressure on pricing for commercial real estate loans that could potentially slow down how much they can increase loan yields in the future.
So competition might cap the upside on the asset yield side. What about funding?
Still competitive there too, even with maybe some anticipation of Fed rate cuts eventually helping. They acknowledge they're still fighting hard for retail CD deposits. Those rates remain elevated due to competition.
And that competitive pressure on deposits leads us to maybe the main tension point on the balance sheet, right? Their loan-to-deposit ratio.
Exactly. You picked up on it. The spot LDR at the end of Q3 was quite high, 97%.
97%. That is pretty rich. It doesn't leave a lot of wiggle room, does it?
Not really. It suggests they're pretty much fully loaned up relative to their current deposit base. If deposit growth doesn't keep pace with loan growth, or if they see outflows,
Then they'd have to turn to more expensive funding sources, like wholesale borrowing.
precisely, things like Federal Home Loan Bank advances, and relying more on those higher cost funds would pretty quickly start to eat into that nice NIM expansion they just achieved.
So that 97% LDR really underscores the importance of continuing to gather those core deposits, especially from initiatives like the USKC one. It almost acts as a ceiling on how fast they can grow without potentially hurting margins.
I think that's a fair assessment. It puts a huge premium on deposit gathering execution going forward, maybe even more so than loan origination volume in the near term.
Okay, so pulling it all together then, the outlook seems to hinge on a few key things they need to keep delivering on.
Yeah, I'd say 3 primary catalysts or validation points to watch. First, can they actually deliver on that newly raised mid-single-digit loan growth guidance in Q4 and beyond without letting credit quality slip or giving away too much on price? Payoffs are always a factor too.
Okay, validate the growth guidance. What's second?
Second is realizing those deposit cost tailwinds. We saw that really promising data point for October. They need that trend of moderating deposit costs to continue, especially if Fed cuts do materialize eventually. That's crucial for protecting the in.
Right, continued relief on funding costs.
Right.
And third,
Third is simply the execution on the buyback, following through with those signaled ongoing quarterly share repurchases, providing that consistent capital return. The pacing matters.
growth validation, deposit cost relief, and buyback consistency. Makes sense.
If they can nail those 3 things, then this outstanding Q3 starts to look less like a one-off and more like the start of a sustained trend.
All right. This brings us perfectly to our final segment. What could this all mean for someone, looking for an interesting idea in the regional bank space? It's time for This Is Not Financial Advice.
Okay, let's frame the idea. The core thesis here, I think, is that HAFC isn't just a play on interest rates going up or down. It's really an execution story. You've got this combination of, first, superior efficiency. That 52.65% ratio is really good, a 2-year low. Second, you have this unique proprietary growth engine with the USKC initiative that differentiates them. And third, they're deliberately building recurring fee income streams from mortgage and SBA sales. That positions them arguably much better than many regional peers who are maybe just relying solely on traditional spread lending.
Plus, the buyback provides support.
Exactly. That commitment to ongoing share repurchases provides a nice floor, a signal of confidence from management about the valuation.
Okay, so the thesis is execution and differentiation. What's the actual trade idea then?
Well, the trade idea would be long HAFC. You're essentially betting that the market hasn't fully appreciated this combination yet. You're betting that their demonstrated ability to drive that core PPNR up 16.4% in a quarter, fueled by the unique USKC niche and the diversified income streams plus the capital returns, that all this will lead to the stock deserving a better multiple, maybe a continued relative outperformance compared to the broader KRE regional bank index, which, has had its struggles.
So, long HAFC, betting on continued execution leading to multiple expansion relative to peers. What specifically would validate this trade in the coming quarters? And conversely, what's the main risk that blows it up?
Validation comes directly from those catalysts we just discussed. Strong Q4 execution, meaning they hit or get close to those new loan growth targets without credit issues. And critically, confirmation that deposit costs are indeed continuing to moderate like that October data suggested. If funding costs keep falling nicely, that really unlocks earnings potential.
Makes sense. And the risk?
The main risk, I think, goes back to those competitive dynamics in the LDR. An unexpected negative turn in credit quality would obviously hurt. Or, perhaps more likely, a really fierce pricing war, particularly in CRE, that erodes their loan yields faster than they can get relief on deposit costs.
Right, if NIM gets squeezed despite their efforts.
Exactly. And that high 97% LDR means they have very little room for error on the deposit side. A sudden outflow or inability to fund loan growth cost-effectively would definitely challenge the thesis.
A clear execution bet with identifiable catalysts and risks. That was a fantastic deep dive. So just to quickly recap the highlights for everyone. A big EPS beat, that impressive 15 basis point NIM expansion driven by smart liability management, the swing to net credit recoveries, and management stepping up with higher loan growth guidance and a commitment to ongoing buybacks.
Yeah, and I think the central question it leaves us with, and maybe something for you listening to consider, is this. Can Hanmi Financial keep this up? Can they leverage that unique USKC growth engine, maintain this really clean credit execution, and keep generating those fee incomes, all while navigating the persistent competition and managing that high loan-to-deposit ratio? Q3 suggests they absolutely have the playbook, but the challenge is always consistency.
A great question to ponder. Thanks for joining us on this deep dive into HAFC's Q3 call. As always, please remember this discussion was for informational purposes only. It is definitely not financial advice. We strongly encourage you to do your own research and dig into the source materials yourself. We'll talk to you again soon on the next deep dive.